Picture it's a Sunday night and you're staring at your Airbnb earnings, wondering how much of it the tax office is going to want. Here's something you should know. Airbnb and stays hand your income data straight to the ATO, so it already knows what you earned. If that makes your stomach drop a little, that's completely normal. Most hosts were never told the reporting worked this way. But here's the part most people miss. Declaring properly is exactly where you claim thousands back. Over the next few minutes, I'll walk you through what income you report, what you can deduct, and one capital gains trap that can cost you tens of thousands later. Stick with me, because getting one number wrong here is genuinely expensive. Let me show you why this matters before we get practical. If you underdeclare even $5,000 of Airbnb income, the ATO can add a 75% intentional disregard penalty on top of the tax and interest you owe. That turns a roughly $1,575 tax bill into more than $2,750 of total debt, according to ATO penalty guidance. And because the platforms report your earnings directly, this is easy for them to spot. Now here's the good news that flips the whole thing around. Do this properly and you can legally claim a big chunk back. Let me show you exactly how. Step 1. Find out exactly what the ATO can see. Log into Airbnb, go to your transaction or earnings history, and export the full report for the financial year. That report shows your nightly rent, cleaning fees, and the Airbnb service fees taken out. Then log into MyGov, open ATO online services, and start your return to view the pre-filled sharing economy income. Now match the two side by side. If the numbers don't line up, the ATO usually has the higher figure, and that's the one you'll need to explain. This one reconciliation removes the single biggest audit trigger there is, so it's worth 10 minutes of your time. Step 2. You declare every dollar. The ATO treats all short-stay earnings as assessable income, and you report the gross amount. That's before Airbnb takes its cut. So that's your nightly rent, the cleaning fees you charge guests, any late checkout pet or extra person fees, and importantly, any direct bookings you take off platform through Instagram or word of mouth. If you charge $220 a night across 120 nights, that's $26,400 of income plus your cleaning fees on top. Don't net it down first. You declare gross, then claim your deductions separately, and that order genuinely matters, as you'll see next. Let me put this in real money for you. Say you're like Jess, a Sydney marketer on $95,000 who rents her spare room and earns $25,200 on Airbnb, on the 32.5% marginal rate. That's roughly $8,190 in extra income tax before any deductions, based on the current bans. If you assumed maybe half of it was taxable, and honestly, most people do, that's not how it works. Every single dollar counts as income. But here's why the next steps are so valuable. Your deductions can claw a huge slice of that straight back. Step 3. Claim your direct costs in full. These are the expenses that only exist because you host. Cleaning and laundry for the guest area, guest supplies like toiletries, coffee, and welcome gifts, your Airbnb host service fees, professional photography, advertising, and any short stay management fees. For someone in Jess's position, cleaning at $60 a stay across 120 stays is $7,200, and a 15% host service fee on $25,200 is another $3,780. None of this needs apportioning. You claim all of it because it only ever happens to earn the income. Step 4 is where the real savings hide, and I want to be upfront. This is the part that takes a little effort. Shared costs like mortgage, interest, council and water rates, insurance, electricity, and internet have to be apportioned. The ATO method is straightforward. Take the floor area used for Airbnb as a percentage, then multiply by the proportion of the year that space was available or rented. If you use 45% of your floor space and list for 200 days, that's 55% of the year. 45 times 55 gives you an apportionment factor of about 24.75%. Apply that to $30,200 of shared costs and you're claiming around $7,475. Write that percentage down and use it consistently every year. Now watch how the picture changes when you add it all up. In Jess's case, direct costs of nearly $12,000 plus apportioned shared costs of about $7,500 give total allowable deductions of around $19,455. At a 32.5% rate, that saves roughly $6,320 in tax following ATO deduction rules. Here's the part that should stop you in your tracks. If she'd only claimed the obvious $3,000 of cleaning and supplies, she would have left over $16,000 of deductions on the table, costing her about $5,350 in extra tax that year alone. That's the difference between knowing this and not. Step 5. Don't forget depreciation, because this is the one most hosts genuinely overlook. The furniture and appliances your guests use, the beds, the sofa, the TV, the white goods, can be depreciated over their effective life, and structural improvements like renovations may be claimed as capital works at up to 2.5% a year over 40 years, applied to the Airbnb used portion of the property. The reason people miss these is they're not a cash bill each year, so they're easy to forget, but they're very real deductions. A quantity surveyor's depreciation schedule often pays for itself many times over, but here's the step almost nobody thinks about, and it's coming up next. Step 6 is the one that catches people out years later. Renting part of your home on Airbnb can chip away at your main residence capital gains tax exemption. Say you bought your apartment for $750,000 and it grows to $1,050,000. That's a $300,000 gain, because about 25% of the property was income producing. Roughly $75,000 of that gain could be taxable. After the 50% discount, that's about $37,500 assessable, costing around $12,190 in extra tax when you sell, per ATO CGT guidance. So before you scale up your hosting, do this maths first. It can genuinely change your decision. Before we recap, let me flag 2 mistakes so you sit on the right side of both. First, underclaiming. Many hosts only claim the obvious cleaning and supplies and skip the apportioned interest rates and utilities. Over 10 years, missing just $7,000 of deductions a year is about $22,750 in extra tax paid for nothing. Second, overclaiming. If you claim private use, the ATO later disallows, say $7,000 a year over 3 years, that's about $6,800 of extra tax plus a penalty of up to 75% of the shortfall, pushing your total adjustment over $12,000. The fix for both is the same, and it's simple. Keep every record and apportion honestly. One more thing if you host in Victoria, because this one surprises people. From the 1st of January 2025, there is a 7.5% short stay levy on bookings under 28 days, per the Victorian government. So a $300 night adds $22.50 on top. Here's the important point. This levy is completely separate from your income tax, and you still declare the full rental income to the ATO. Don't assume the levy replaces anything. It's an extra layer, not a substitute. Now let me pull the whole thing together for you. Let's run it back fast so you've got the whole checklist. 1. Reconcile your Airbnb earnings report against the ATO pre-fill in MyGov. 2. Declare 100% of your gross income, including any off-platform direct bookings. 3. Claim your direct Airbnb costs in full. 4. Apportion your shared costs using floor area times days available. 5. Add depreciation on furniture and appliances, plus capital works. 6. Run a capital gains tax check before you ramp up. Get these 6 right and you turn a scary tax bill into a fully optimized audit-proof return, and you'll sleep a lot easier at tax time. If you've made it this far, you now know something most hosts don't: how to declare your Airbnb income cleanly and claim every dollar you're legally entitled to. Your one action today: export your Airbnb earnings report and match it against your MyGov pre-fill. It takes about 10 minutes and it removes your biggest audit risk. Just remember, this is general information only and not tax advice, so check your own situation with a registered tax agent or the ATO. If you want to go deeper, next I'm breaking down the rental property deductions the ATO targets most in audits. I'm Sophie. I'll see you there.